Good morning and welcome everyone to the Moneycontrol live stream. You're watching The Opening Bell. I'm your host, Nickey Mirchandani. Well, in top headlines, market likely to start on a cautious note, tracking uninspiring global setup. SGX Nifty at this point of time is indicating a flattish to negative start coming in for the markets. Asian shares too fell in early trade as the investor wait on the sidelines for factory activity data. US markets, no cues out there, shut on Monday on account of President's Day. FII, they have sold shares worth 158 crore. Again, net sellers out there. Contrasting data, DIIs, however, have bought shares to an extent of around 86.3 crore yesterday. So let us get going and discuss some stocks and strategies today with Amar Singh, who's the Senior Vice President at AngelOne. Good morning, Amar. You expect further weakness coming in for Nifty? If yes, what could act as the support level?
Yeah, very good morning. So what we are seeing is that the markets continue to trade sideways, and Nifty is unable to consistently, or I would say sustain above the 18,000 mark. So on the downside, Nifty's got very strong support around the 17,700 mark. So 17,700 short term, I would say immediate support is around 17,700, resistance around 18,000 level. So that's a range where Nifty is trading. And for any, I would say, major upside move, it has to sustain above the 18,000 mark and then move towards the 18,200. And on the downside, 17,000, if we go below 17,700, then 17,600, that's going to be the next crucial zone of support. So more or less, it's a range play. Technically also, if you look at the charts, they are clearly indicating that there is more or less consolidation happening. And also the markets are awaiting some sort of positive triggers, which unfortunately the markets are not really getting.
Sure. Amar, I'm going to quickly ask you two questions right now. One is on the Bank Nifty level. There is a lot of pressure which has come in for the last 3 consecutive sessions. Levels quickly out there. And the second part question will be the strategy. Is it a buy on dips market or is it sell on rally? How would you approach this market right now?
Yeah, so I would say that for Bank Nifty, the first crucial support is somewhere around 40,400, 500 zone, and below that 40,200. On the upside, the resistance is 41,100 and above that around 41,300 levels. The strategy would be, I would say, it's going to be both. It has to be a sell on highs and a buy around lows because the market is in a consolidation phase. So it's more of a trading range, trading play that's happening in the markets right now.
All right. And what are your top calls for the day? Any two of them that you think would be a profitable bet for the viewers out there?
Yeah. So the first one I would say is Tata Chemicals is one stock one can definitely look at. Currently, it's around 1,000 odd levels. So any pullback in the stock towards 980 can be a good buying opportunity with a stop loss below 970 and a target of 1,030 on the upside. That's one stock one can look at. The other is from the energy space. That is Indian Energy Exchange, IEX. That's one stock which has been consolidating. So it's around 138 odd levels. So this can be a good level to buy with a stop loss below 130 and a target of 150 in the short term.
Sure. Amar, stay on with us. We are just going to quickly address the top movers for the day in terms of the news that we have. ACC-Ambuja there, the Adani Group has ended the standoff. It's a positive coming in on there. Truckers have agreed to 10 to 12% freight tariff cut coming in for Himachal Pradesh, which means that the company can now resume their plant activities out there. This is lower than what Adani Group had originally demanded, to bear that in mind. However, incrementally positive 10 to 15% kind of dip that we saw in volumes on account of this. So that freight rate, issue now being resolved is definitely coming in on the positive side for ACC and Ambuja. Adani Group stocks overall are expected also to be in focus. There, Adani Ports and SEZ has repaid a loan to a tune of around 1,500 odd crore, which is a part of their comeback strategy, and are also going to be paying in another 1,000 odd crore of commercial papers due in March. So that keep an eye out on these ones because clearly the bunch is expected to be in limelight today. Kotak Mahindra Bank, that probably is a big news maker for the day. Not sure more about the reaction, but definitely a big news maker. It's engaged into a consulting firm to find a CEO who could replace the founder, Uday Kotak for that matter. It's a big position to fill in. So do keep an eye out on this one. And also what we'd be tracking in will be the metal counters. There is a recovery probably that most of the brokerages are indicating. JP Morgan has suggested an overweight rating coming in for Tata Steel, SAIL, Hindalco and Nalco. These are the few counters that they're covering. It says that the inventory buildup in China is deaccelerating right now, and they continue to see a good risk reward and attractive price coming in for Indian metals as compared to that of the global peers. So clearly it's seen some underperformance, and now we're expected to see some amount of attractive trend playing out for this in terms of the risk reward ratio. This is what the brokerage at least has to say, and they say there's going to be a price hike per se coming in on the entire group, rather the theme. So keep an eye out on this one. And other stocks and news that we have for us is BEML, that has signed, the company has signed an MOU with DMRC for an SPV. It's an actually DMC-led SPV for Bahrain Metro Rail project. So do keep an eye out on this one. In other news, we have Asian Paint subsidiary also entering an MOU with the Gujarat government to set manufacturing facilities out there. Precall. Now that is one name which is expected to continues to hog limelight for third consecutive session. Minda Corp had a con call yesterday where they suggested Precall is just going to be a purely financial investment because they were sitting with some surplus fund and found this particular company as an attractive investment opportunity. So nothing more over and above what we see, but this is long and short of what we are going to be covering in terms of the stocks and news. But we're going to quickly toss it back to Amar and ask him, how does he look at these stocks and news? Anything that, probably looks attractive to him at this point of time? Metal counters specifically, does he see some amount of stage back on those?
Yeah, looking at the metal counters, they definitely seem to have in the short term bottomed out, because looking at the stocks like Tata Steel, we saw that the stock did correct, but currently it's seeing some sort of pullback. So this is one stock which has got now very strong support around the 100 mark, but the upside seems to be capped around 120, 130. So it's more of a trading play, I would say, for Tata Steel. If I look at the other metal counter which you talked about as SAIL, so if I look at Steel Authority of India, that's also having a similar pattern as to Tata Steel. So it's more of a, I would say, consolidation and with a positive bias. So any dips can be used as a buying opportunity, and but one should look at booking at higher levels. So for Tata, if you look at Tata Steel, so if you look at Tata Steel, so somewhere in the range on the higher side, it wouldn't trade above the 95 mark. So that's a range of resistance. On the downside, it's got good support around 80 odd levels. So it's more of a range play for both Tata Steel and SAIL.
Fair point. Amar, also, what do you make out of the IT counters right now? We've seen significant amount of participation coming in from the IT counters per se in the past few sessions, right? It's been probably in tandem with the global rally that overall we're seeing with the IT stocks. But do you think it's attractive still at these levels? But before that, Amar, we'll try to get back to the opening of market and then come back to you, Amar. It looks like, a positive start coming in for the markets, 0.2% out there. So clearly, despite the cautious setup that we were looking at, market has opened on somewhat positive note. What remains to be seen is whether it can cross that 18,000 level per se. Bank Nifty, there is not support coming in from that one. We're seeing some amount of losses, or rather flattish trend coming in from Bank Nifty. Well, for broader indices also, mid-cap index is open and positively, 0.2 gains that we're looking at for, the mid-cap. Small-cap too seems to be participating right now. At least a positive start coming in on this one. Surprising setup, right? We were actually bracing for a cautious start, but we have somewhat a positive trend coming in. Don't forget, it's a weekly F&O expiry, or rather the month is of F&O expiry. So we're seeing some amount of volatility playing on account of that. And if we can can just look at the top gainers and losers that we have on our screen when it comes to the Nifty index per se, the top 3 gainers and losers probably will help us understand where is the trend going right now. Of course, Nifty 50 index, that's open with gain of around 0.2%, and broader index too seems to be participating into the rally overall. But if you could just pull up the top Nifty gainers, NTPC, Tata Steel, UPL, these are the top 3 counters. Like we suggested, metal could could stage a comeback, and there we're seeing Tata Steel, which is played out just as per the script and probably participating into the rally, or rather the positive trend coming in for the markets right now. We also have DRL, Infosys, HCL Tech. So metal and IT, they are clearly the theme, the trends that are expected to play out for the day. And let's look at the top losers out there: Adani Enterprises and Axis Bank. At this point of time, the market breadth seems to be pretty positive also. Amar, I'm going to quickly toss it back to you and ask you, were you expecting this kind of a start? And if yes, now what is the levels that we can look at?
I would say that markets, this is more of a positive bias with the opening with a positive bias, but I wouldn't read too much into it because it's just start of the market. Because technically, I would say the markets clearly point towards consolidation. So as I said, one needs to watch out for the 17,700 on the downside and 18,000 on the upside. And it's more of a very good range to trade the markets. So you sell around resistance, you buy around support, and then you have a very good opportunity of trading successfully in the market. Still, we see a breakout above this range. So that's not what we are witnessing for quite some time.
When you say breakout above that range, what levels would you see the breakout coming through, which will make you believe that the trend now looks to be sustainable per se?
Yeah, if you ask me, the exact range would be above 18,200. But before that, 18,000 is also a psychological level, and also the market has been trying to breach, sustain above that level, and not able to really sustain above that. So it's trying to reach, and then it's collapsing from there. So 18,000 is a level where if the market sustains above that level, then one can look at a rally towards 18,150, 18,200 mark. But otherwise, it's more of a consolidation in the markets, and also other data points. If you look at, they are also clearly pointing out that there is higher levels, there is some selling pressure which we are witnessing.
All right, Amar, we'll leave it at that. Thank you so much for taking out the time and speaking to us as always. All right, it's time that we bring in the next Techno-Funda guest on our show, Mayuresh Joshi, who's the head of research equities for William O'Neill and Company. Mayuresh, good morning. How do you overall see at the markets right now? Pretty broad-based questions that I'm asking. Probably I'm going to start off by the IT and metal index. You've seen some amount of positive traction coming on this one. What do you make out of it?
Good morning, Nicky. Always a pleasure to be on your show. So two things. One, the way the dollar index is moving at this point of time, you're obviously going to see a sentimental reaction in terms of trades specifically towards the metals part. And when it comes to the IT sector as a whole, the US economy is still resilient at this point of time. So even if we get a series of extended rate hikes, the Fed minutes will obviously indicate that today evening. We're probably expected to see the economy probably not going to a deep shell. So having said that, IT companies who are basically outsourcers at our end should get reasonable amount of order inflows in such a situation. And therefore, I think the kind of parameters that are improving, headcount is now becoming far more stable, wage costs have become far more manageable, attrition levels have become manageable as well. And therefore, I think the EBITDA margin sustainability, along with expectations of revenue flow, both in dollar and constant currency terms, expected to be stable. I think all these are pointing out for IT being a very stable trade at this point of time in the volatile environment that we are from.
Mayuresh, on a very fundamental level, we've seen hiring slowdown coming in for IT counters per se. All right, so we're seeing hiring slowdown coming in for the IT counters. What do you make out of this? And also, are you still looking mid-cap IT space? Does that look attractive to you as compared to the large-cap counters?
So relatively, I think the kind of pain, Nicky, that these companies went through in terms of hiring specifically after the unlock phase a few quarters back, now they've got a problem of plenty, right? Because I think the supply suddenly started coming through for the entire sector as a whole. And somewhere you're seeing wages probably getting approved, at least at the bottom pie for the sector as a whole. So the entire perspective is in the next quarter how the overseas economies probably behave and whether order flows, as we are speaking at this point of time, remains constrained or gets cut significantly. So to that extent, I think the utilization levels of ex-trainees as well becomes extremely important. But I think the sustainability, at least on key parameters, looks quite stable at this point of time. Whether you look at mid-cap or large-cap IT companies, a lot of mid-cap IT companies, if you probably look up at the valuation stack, are obviously expensive at this point of time. Purely comparing it with the large names, a very selective action coming through. A few companies did report very strong set of numbers with the mid-cap IT pack, Persistent, Coforge, KPIT, to name a few. But a lot of these companies are in late-stage basis as per the O'Neill lens, which basically means that they can succumb to profit booking at any point of time as the market volatility probably increases. So I think staying with leaders, large-cap names probably remains the mantra. But we are, as I said, equally weight on the IT sector at this point of time. Most of the positives have got gestated with the moves that you've probably seen. I think these quarters numbers, the Q4 numbers which will come through, and what probably happens on a macro level, both in the US and the European economies, will determine the larger term trajectory for the sector as a whole for this calendar.
Mayuresh, actually, that's pretty much a contra call coming in on the IT space when you say that you would probably like to stick to the leaders, because probably you're looking at, the large cap counters, because most of the experts that I spoke to probably spoke to the mid cap, spoke much about the mid cap IT space being more attractive in terms of the earning potential. But I'm going to toss it back now to you and ask you probably about the recovery that we've seen in the staple or the FMCG basket per se. You think El Nino could drag the rural recovery that the basket has staged thus far? What do you make out of it?
So I hope it does not happen, and I'm not a weather expert at this point of time. But if it does happen, obviously, I think the kind of impact that will come through can be significant because we've just started seeing some green shoots, Nickey, as far as the rural consumption is concerned. Obviously, they've gone through pain over the last few quarters, but key indicators are pointing out that this quarter onwards, recovery should start in real earnest. And Q1 onwards, there should be a full-fledged recovery that probably should come through in terms of rural economy. In terms of consumption patterns itself, the expectations in terms of a good Rabi output expected to come through, and expectations of a good sowing for the Kharif season, more MSP increases in terms of key crops, specifically cash crops expected in the next few months. That should support and abet the entire consumption-led story that we really speak about. The second element for FMCG companies in general, rural consumption becomes a key factor because almost 50-60% in terms of sales that probably happens, both in terms of volumes as well as price-led sales in terms of the SKUs that they've got for semi-urban rural markets happen in the hinterlands of India. And therefore, I think the expectations, fingers crossed, of a normal monsoon should start driving up the rural economy. And basically, that will drive a volume-led price growth for a lot of these FMCG companies. Whether El Nino happens or not, I think too premature at this point of time, but I hope it does not happen. If it does happen, obviously it impacts the sector and the rural sentiments quite significantly.
So, Mayuresh, would you still stick to something like an HUL or ITC for that matter in the FMCG basket, or you have different picks out there?
So we do like, I mean, at a global level, at a global research level, we do like ITC. Two, three things happening very positively. One, I think there were no negative implications as far as the budget is concerned, specifically in terms of their core business, which is the cigarette business. So there again, the expectations of reasonable volume growth with reasonable EBIT margins and strong cash flows continue. The other legs of their business where a lot of capital investments have gone through over the last few years. The other FMCG business is looking very, very stable with very stable EBIT margins at this point of time. Paper business is looking strong. I think if you look at paper companies' numbers, very strong set exhibited. The hotel business is looking extremely strong as well with the kind of data points that we are getting for the entire sector as a whole. And agri trading should bounce back very, very smartly for all the reasons that mentioned for the FMCG sector related to the agri sector as a whole. So I think all the elements are probably coming through, which means that the top line growth should be very, very good. EBITDA margin should sustain around the current levels as well. And bottom line growth should be in the region of 20-25%, which is a key monitorable of the O'Neill methodology and lens that we track. So yeah, I think out of the large cap names, ITC is something that we do recommend from our global basket as far as India is concerned.
All right, Mayuresh, I'm also going to touch base on the aviation sector because the domestic passenger data, that traffic has nearly doubled. Of course, there is a base effect coming to play on this one. But overall, how do you look at the sector and which are the counters that look attractive to you?
So it's a very interesting space, Nickey. And obviously, if you probably look at and track data points pre-COVID and where we are at this point of time, we are getting there in terms of both passenger load factors as well as overall utilization levels as well. These companies typically, I think, are dependent on too many external factors. So how crude moves, that crude is very stable at this point of time. But for any unknown factor, if crude moves significantly higher, it does take an impact because 40-45% of their overall costs is aviation turbine fuel, which is related to how crude and crude prices will move. The second element in terms of competition brewing up, you obviously seen a huge order that sentimentally impacted a few players, including Indigo, to a certain extent. And as these planes start coming on stream over the next few quarters, the capping of rates and routes, which probably happen in terms of fares, might be a reality. Is there significant growth that can be expected? The government has announced 50 new airports over the next few years, which will start coming through. Obviously, there's a new Mumbai airport, which will also start coming through, which means air traffic is going to increase exponentially over the next few years, become far more affordable. So from a structural story, I think it probably is having all the triggers in place. But from an immediate short to medium term perspective, I would view these to be trading bets because of too many external exigencies that these stocks operate out of. And largely, I think a lot of this is beyond their control. So frankly, I think from a short to medium term perspective, you can view stocks like an Interglobe, SpiceJet as an example again, for more or less to be trading bets.
Fair enough. Mayuresh, talk about defense stocks because they've seen significant amount of traction both in terms of the stock price and also the news that have been, they've been making the news for quite a while. If you see every day we're looking at we're really looking at, some amount of news fit which is coming through on these defense name, HAL, BEML, all of these are the ones which are probably, seeing some amount of traction. But in today's rate, we aren't seeing that traction building up though. But however, how are you looking at the theme overall? Do you think there is a value buy per se from overall from this basket?
So few stocks have definitely become very, very expensive, Nickey. Also, if you probably look at numbers, I think the expectations in terms of significant outperformance when it came to operating leverage for a lot of these defense companies probably was missing in this quarter and probably might be a little bit soft in the coming quarter as well. And therefore, I think if you map historical valuations in terms of how their standard deviation is to mean, it looks a tad bit expensive for a few players. You've seen significant outperformance for players like an HAL, Masgao Dock, as an example. And therefore, I think the kind of budget allocations that have happened to defense at this point of time, the entire order win proposition that happens for this sector as a whole, as far as Atmanirbhar Bharat is concerned, I have no second thoughts that orders will keep on flowing through for this sector as a whole. And therefore, I think the execution timelines and expectations of performing well in terms of margin performance as well, along with strong cash flow and bottom line performance, should grow at a reasonable pace. But we've also got a base to comprehend with. With this year's performance, can they outbeat by a significant margin to sustain the premium valuations that they've probably got? I think this is what the street is probably looking at. Or is it going to be a mediocre performance where you're looking at a single-digit outbeat, where those elevated valuations then don't look attractive, stretched over the next couple of years in terms of forward numbers. So I think you have to be very, very selective in this space. For all the reasons mentioned thereof. Companies which will perform reasonably well in terms of earnings outbeat on their own parameters on a year-on-year basis, quarter-on-quarter basis as well, should relatively do well. And therefore, being very, very selective in this space is something that investors should be.
All right, Mayuresh, I'm just going to quickly chat about metal counters overall also. Just a little bit detail of how do you see the ferrous versus non-ferrous space? Do you see the traction now building in more for the ferrous space as compared to the non-ferrous space? Of course, because the inventory build-up today, there was a JP Morgan report which suggested that the inventory build-up per se in China is going down. Do you expect domestic price hikes also to come through and probably benefit from this situation?
So for the entire theme as a whole, prices have come down significantly, specifically the last few quarters as China went for lockdown. As it is opening up at this point of time, and as restocking will start taking place, you've already seen proxies like iron ore prices, coking coal prices starting to move up, stuff firming up also happening in terms of steel prices, both HRC and rebar prices, ex-China FOB. And therefore, I think there is some respite that is expected to come through for both the ferrous and the non-ferrous space as well. Now, when it probably comes to the steel players, if you probably look at a few numbers, including Tata Steel, if you probably look at numbers in the non-ferrous space, which includes Novelis as well, realizations obviously have been down quite significantly over the last few quarters. And therefore, I think the demand dampening situation where volumes have actually gone down and prices have gone down, I think that negative leverage is probably, operating leverage is probably playing out on balance sheets. That might continue till we see some element of a recovery coming through for these economies as a whole. China might act as an outside factor at this point of time. Indian domestic demand remains pretty resilient, but input costs have started moving higher. And therefore, the expectations in terms of some price hikes, specifically when it comes to hot rolled coils or cold rolled coils, can come through. But if you probably want to balance out between the ferrous and the non-ferrous players, I think the base metals, which is non-ferrous specifically, players within the aluminium copper space, probably look a little bit more attractive because prices might have bottomed out. Inventory levels are at an absolute low level at this point of time. Expectations of strong demand expected to come through for the end user application, whether you're talking about beverage cans, electric vehicle casings that you're looking at the battery casings where a lot of these base metals probably go through. I think the demand can be exponential if you look forward over the next 2 to 3 years. So given a trade-off between ferrous and non-ferrous probably might look a tad bit better at this point.
All right, Mayuresh, we'll leave it at that. Thank you so much for taking out the time and speaking to us as always. Well, with this, it's a wrap. Thank you so much for watching. Please do post your feedback for us in the comment section below and follow us on the link at the bottom of your screen for the rest of the updates. Stay tuned to moneycontrol.com and Moneycontrol app.